The cost of higher education continues to rise, making college savings a crucial aspect of financial planning for families. Early planning and consistent saving can significantly ease the burden of tuition fees, accommodation, and other educational expenses. Without a dedicated savings plan, families may face financial strain or limit their children's educational opportunities. Starting early allows for the power of compounding to work its magic, growing your savings exponentially over time. Saving for college provides peace of mind, knowing that you're prepared for this significant investment. It allows students to focus on their studies without the added stress of financial worries. A solid college fund can open doors to a wider range of educational institutions, giving students more choices. It also reduces the need for student loans, which can take years to repay after graduation. Investing in a child's education is an investment in their future, empowering them to pursue their dreams and achieve their full potential. By starting early and saving diligently, families can create a brighter future for their children and give them a head start in life. A well-funded college education can lead to better career opportunities and higher earning potential. It also equips individuals with the knowledge and skills to contribute meaningfully to society. Mutual funds offer a convenient and diversified way to invest in the stock market, making them a suitable option for college savings. They pool money from multiple investors to invest in a portfolio of stocks, bonds, or other assets managed by professional fund managers. This diversification spreads the risk across various investments, reducing the impact of any single investment's performance. Mutual funds also offer affordability, allowing investors to participate in the market with relatively small amounts. Investing in mutual funds provides the potential for long-term growth, particularly through equity funds, which invest primarily in stocks. They offer a hands-off approach to investing, as the fund managers handle the day-to-day management of the portfolio. Mutual funds come in various types, catering to different investment goals and risk tolerances. Investors can choose funds that align with their specific needs and time horizon. The flexibility of mutual funds allows investors to easily adjust their investment strategy as their goals evolve. They can switch between different fund types or redeem their investments when needed. Mutual funds are regulated by government bodies, providing a level of investor protection. They offer transparency, with regular reporting on fund performance and holdings. Mutual funds offer a compelling way to save for college, combining growth potential with diversification and professional management. They empower families to build a secure financial foundation for their children's education. By leveraging the benefits of mutual funds, investors can maximize their savings and achieve their college funding goals. Starting early and investing consistently can make a significant difference in the long run. Equity funds invest primarily in stocks, offering the potential for higher returns over the long term, making them suitable for long-term goals like college savings. They represent ownership in companies and participate in their growth potential. Equity funds are ideal for investors with a longer time horizon, as they can ride out market fluctuations and benefit from the overall upward trend of the stock market. SBI Equity Hybrid Fund, for example, offers a blend of equity and debt investments, providing a balance between growth and stability. SBI Equity Hybrid Fund aims to provide long-term capital appreciation along with regular income, making it a suitable option for college savings. It invests in a diversified portfolio of stocks across various sectors, reducing the impact of any single sector's performance. The fund's hybrid nature provides a cushion against market volatility, as the debt component offers some stability. It is managed by experienced professionals who actively monitor the market and adjust the portfolio accordingly. SBI Equity Hybrid Fund offers various investment options, including systematic investment plans, which allow investors to invest regularly with small amounts. It provides liquidity, allowing investors to redeem their investments when needed. The fund has a track record of delivering competitive returns, making it a popular choice among investors. It is readily accessible through various online platforms and distributors. For long-term goals like college savings, where the time horizon is typically long, equity funds can play a crucial role in maximizing growth potential. They offer the opportunity to participate in the stock market's upward trajectory and build a substantial corpus over time. By investing in well-managed equity funds like SBI Equity Hybrid Fund, investors can secure their children's educational future. Starting early and staying invested allows the power of compounding to work its magic. As the college start date approaches, It's prudent to shift from equity funds to debt funds to preserve capital and minimize the risk of market fluctuations. Debt funds invest primarily in fixed income securities like bonds, offering relatively stable returns and lower risk compared to equity funds. This transition helps protect the accumulated savings from potential market downturns as the goal nears. SBI Magnum Ultra Short Duration Fund, for example, is a suitable option for short-term investments, offering stability and liquidity. SBI Magnum Ultra Short Duration Fund invests in high-quality short-term debt instruments, minimizing the risk of interest rate fluctuations. It aims to provide stable returns while maintaining high liquidity, making it ideal for preserving capital in the short term. The fund is managed by experienced professionals who actively monitor the market and adjust the portfolio to optimize returns and manage risk. It offers various investment options, including online platforms and distributors. SBI Magnum Ultra Short Duration Fund is suitable for investors seeking stability and liquidity in the short term. It provides a safe haven for accumulated savings as the college start date approaches. The fund has a track record of delivering consistent returns, making it a reliable option for preserving capital. It offers easy access to funds when needed, ensuring that the investment can be readily available for college expenses. Transitioning to debt funds as the goal nears is a crucial step in managing college savings. It helps safeguard the accumulated corpus from market volatility and ensures that the funds are readily available when needed. By choosing suitable debt funds like SBI Magnum Ultra Short Duration Fund, investors can preserve their capital and achieve their college savings goals. This strategic shift towards stability helps mitigate risks and provides peace of mind. Section 5. Nearing the goal. Managing investments as college approaches. As the college start date draws closer, actively managing your investments becomes increasingly important. Regular monitoring of your portfolio's performance is essential to ensure it aligns with your financial goals. Consider diversifying your investments across different asset classes, such as stocks, bonds, and cash, to mitigate risk. Rebalance your portfolio periodically to maintain your desired asset allocation, which can help protect against market fluctuations. Start gradually shifting your investments from higher-risk assets, like stocks, to lower-risk options, such as bonds and cash. This transition helps preserve your capital and reduces the potential impact of market volatility as you approach the college start date. Consider setting up a systematic withdrawal plan to ensure you have regular access to funds when needed for college expenses. This allows you to withdraw a predetermined amount at specified intervals. Carefully evaluate the expense schedule provided by the college and plan your withdrawals accordingly. This will help you avoid any last-minute financial surprises. Maintain open communication with your child about the college funding plan. Discuss the expected expenses, available resources, and any potential funding gaps. This transparency can help avoid misunderstandings and ensure everyone is on the same page. Having a clear understanding of the college's payment schedule and your available resources is vital. This allows you to plan your withdrawals strategically and avoid any financial shortfalls. If you anticipate any funding gaps, explore options such as scholarships, grants, or student loans to bridge the difference. By actively managing your investments and communicating effectively with your child, you can ensure a smooth transition into college life. Section 6. Claim your reward, free financial calculators. As a thank you for staying with us until the end, we're offering access to free financial calculators. These tools can be invaluable in helping you plan and manage your college savings. Use a college savings calculator to estimate how much you need to save based on your child's age, expected college costs, and desired investment return. A loan calculator can help you determine the potential monthly payments and total interest costs of student loans should you need to borrow. A budget calculator can assist you in creating a realistic budget for college expenses, including tuition, fees, room and board, books, and other miscellaneous costs. A savings goal calculator can help you determine how much you need to save each month to reach your college savings target. These calculators can provide valuable insights and help you make informed decisions. To claim your free access to these financial calculators, simply visit our website and click on the Calculators tab. You'll find a variety of tools to help you with your financial planning needs. These calculators are designed to be user-friendly and provide accurate results based on the information you input. Understanding your financial options early can make a significant difference in your ability to afford college. These calculators can empower you to make informed decisions about saving, borrowing, and budgeting for your child's education. Don't wait. Claim your free access today and start planning for a brighter financial future. Section 7. Understanding the risks of mutual fund investments. While mutual funds offer a convenient and diversified way to save for college, it's essential to understand the risks involved. Market risk, the most prominent risk, refers to the potential for fluctuations in the value of your investments due to overall market conditions. Interest rate risk affects bond funds, as rising interest rates can decrease the value of existing bonds. Inflation risk erodes the purchasing power of your returns over time, especially if inflation outpaces investment growth. Credit risk applies to bond funds and refers to the possibility that the issuer of a bond may default on their payments. Liquidity risk, although less common with mutual funds, can arise if you need to sell your investments quickly and there are not enough buyers in the market. Expense ratios, the fees charged by mutual funds to cover management and administrative costs, can impact your overall returns. Diversification within a mutual fund does not eliminate all risk. While it reduces the impact of any single investment's performance, the overall value of the fund can still fluctuate based on market conditions. It's crucial to choose funds that align with your risk tolerance and investment goals. If you're uncomfortable with market volatility, consider opting for more conservative fund options. Understanding the risks associated with mutual funds is crucial for making informed investment decisions. By carefully assessing your risk tolerance and diversifying your investments, you can mitigate potential losses and achieve your college savings goals. It's always advisable to consult with a financial advisor for personalized guidance based on your individual circumstances. They can help you develop a tailored investment strategy that aligns with your risk profile and financial objectives. Section 8. Diversification and asset allocation for college savings. Diversification, a key principle of investing, involves spreading your investments across different asset classes to reduce risk. Asset allocation refers to the strategic distribution of your investments among various asset classes, such as stocks, bonds, and cash, based on your investment goals, time horizon, and risk tolerance. For long-term goals like college savings, a higher allocation to stocks is generally recommended, as they offer greater growth potential over time. As you approach the college start date, gradually shift your asset allocation towards more conservative options like bonds and cash to preserve capital. Rebalance your portfolio periodically to maintain your desired asset allocation and avoid overexposure to any single asset class. Diversification within each asset class is also important. For example, within stocks, consider investing in different sectors and market capitalizations. Diversification doesn't guarantee profits or eliminate the risk of loss, but it can significantly reduce the impact of market fluctuations on your overall portfolio. By spreading your investments across different asset classes, you're less likely to experience significant losses if one particular asset class underperforms. Asset allocation is a dynamic process that should be reviewed and adjusted periodically based on your changing circumstances and market conditions. A well-diversified portfolio can help you weather market storms and achieve your college savings goals. By strategically allocating your investments across different asset classes and rebalancing regularly, you can manage risk effectively and maximize your potential returns. Consulting with a financial advisor can provide valuable insights and personalized guidance on diversification and asset allocation strategies. Section 9. Monitoring and rebalancing your college savings portfolio. Regularly monitoring your college savings portfolio is crucial for staying on track with your financial goals. Review your portfolio's performance at least annually, or more frequently, if market conditions warrant. Compare your returns against relevant benchmarks and assess whether your investment strategy is still aligned with your objectives. Rebalancing your portfolio involves adjusting your asset allocation to maintain your desired target percentages. Over time, market fluctuations can cause your portfolio to drift away from your target asset allocation. Rebalancing helps restore your original allocation and manage risk effectively. If your stock holdings have grown significantly, you might sell some stocks and buy bonds to bring your portfolio back to its target allocation. Conversely, if your bond holdings have increased, you might sell some bonds and buy stocks. Rebalancing can be done on a set schedule, such as annually or semi-annually, or based on specific thresholds, such as when an asset class deviates from its target allocation by a certain percentage. Don't be afraid to make adjustments to your investment strategy based on your changing circumstances, such as a change in your risk tolerance or time horizon. Monitoring and rebalancing your portfolio requires discipline and attention, but it's essential for long-term investment success. By regularly reviewing your portfolio's performance and making necessary adjustments, you can ensure that your investments are working towards your college savings goals. Rebalancing helps manage risk and keeps your portfolio aligned with your desired asset allocation. Consider using online portfolio tracking tools or consulting with a financial advisor to simplify the monitoring and rebalancing process. Section 10. Tax implications of mutual fund investments for education. Understanding the tax implications of mutual fund investments is essential for maximizing your college savings. In the United States, qualified tuition plans, such as 529 plans, offer tax-advantaged ways to save for college. Contributions to 529 plans may be tax-deductible at the state level, and earnings grow tax-deferred. Withdrawals for qualified education expenses, including tuition, fees, and room and board, are generally tax-free at the federal level and often at the state level as well. Coverdell Education Savings Accounts, or ESAs, are another tax-advantaged option, though they have contribution limits and income restrictions. Earnings in ESAs grow tax-deferred, and withdrawals for qualified education expenses are tax-free. Tax implications can vary depending on the specific type of mutual fund and your individual circumstances. For example, capital gains distributions from mutual funds are taxable, even if they are reinvested. It's important to consult with a tax advisor or financial planner to understand the specific tax implications of your mutual fund investments for education savings. They can help you choose the most tax-efficient investment strategy based on your individual situation. Keep thorough records of your contributions, earnings, and withdrawals to facilitate tax reporting. Be aware of any changes in tax laws that may affect your college savings plan. Understanding the tax implications of your investments can help you minimize your tax burden and maximize your college savings. By leveraging tax-advantaged accounts and strategies, you can ensure that more of your money goes towards your child's education. Staying informed about tax laws and seeking professional advice can make a significant difference in your overall financial planning. Section 11. Conclusion. Start early, invest smartly. Saving for college is a significant undertaking, but by starting early and investing wisely, you can achieve your financial goals and secure your child's educational future. Mutual funds offer a convenient and diversified way to invest in the market, providing the potential for long-term growth. Equity funds are suitable for long-term goals, while debt funds offer stability as the college start date approaches. Understanding the risks and rewards of each fund type is crucial for making informed investment decisions. Diversification and asset allocation are key principles for managing your college savings portfolio effectively. Regular monitoring and rebalancing ensure that your investments stay aligned with your goals. Leveraging tax-advantaged accounts and strategies can help you maximize your savings. Don't wait until the last minute to start saving. The earlier you begin, the more time you have to benefit from the power of compounding. Even small contributions made consistently over time can make a significant difference in the long run. Take advantage of free financial calculators and resources to help you plan and manage your college savings. Consult with a financial advisor for personalized guidance based on your individual circumstances. They can help you develop a tailored investment strategy that aligns with your risk tolerance, time horizon, and financial objectives. Investing in your child's education is an investment in their future. By starting early, investing smartly, and staying informed, you can empower your child to pursue their dreams and achieve their full potential. Don't let the rising cost of college deter you. With careful planning and disciplined investing, you can make college a reality for your child.